Hi there, Mr. Holcomb here with another episode of The Math Behind the Modules. Okay, lesson 8.3, stock market data charts. Objectives: interpret a stock bar chart, create a stock bar chart. Don't know why we're doing that. There's software out there that does it for you. But anyway, interpret a stock candlestick chart and create a stock candlestick chart. All right, so let's go over the definitions first. Stock chart is pictorial information on stocks from a day's worth of data to multi-year data trends. Most stock charts present historical information about the trading prices and volumes of a particular stock. All right, stock bar chart, a chart made up of two graphs. The top part shows daily information about the day's highs, low, open, close, prices of the particular stock, and the bottom part shows the volume, how many people bought and sold. All right, and then the candlestick chart, my favorite. I love candlestick charts. That's what I use. It's a chart like a stock chart, but with a top line that indicates the high price and a low line that indicates a low price for a given period. The rectangular region known as the real body is displayed in two different colors. Green candlestick indicates that the closing price is greater than the opening price, and the red candlestick indicates the closing price is less than the opening price. I don't know about those lines. They're calling them lines. I call them wicks. Since it's a candle, it's a wick. Get it? All right. So anyway, that is the vocabulary for 8.3. Let's get to it. Okay, example 1, it says here you learn how to interpret and create stock charts. The stock bar chart below presents trading information for the week of April 28th for Gold Point Manufacturing Company. Example 1, which day had the highest price? Which day had the lowest price? So let me explain some of this stuff to you here. So I'm going to use different colors. Let's use, I don't know, purple for our open. So right here at the beginning of the week, this little line right here, that is where it opened. It opened at $8.15 on the 28th. 29/30/12. April has 30 days, so there's no weekend here. So this is Monday and this is Friday. Monday, Tuesday, Wednesday, Thursday, Friday. The stock market does not trade on weekends. All right, so it opened at $8.15, and this top line right here means that's as high as it got that day on Monday, which is about $8.42. But it didn't stay up there. It also went down as low as $8.10. So it dropped 5 cents sometime during the day below the open, and it fluctuated around and got as high as 8.42 or 3. But it closed right here at 8.21, I would say approximately. Okay, so that's how you read the chart. The next day it gapped up just a smidge and it opened at say 8.22 or 8.23. It got as high as $8.37, but dropped as low as $8.08. So this right here is our lowest low of the week right there at 8.08 approximately. That's the lowest it got. And then it closed here at 8.11 or 12. So it closed lower than it opened. And I don't use these types of charts. If this were a candle chart, this would be red because it closed below the open and so on. And that continues. And so this high is higher. Let me undo that. Let me turn to green for positive movement. There is a high, okay, and then it closed lower than that high here, and I keep going over. It closed a little bit higher there, so there's our new high of the week, but then it gapped way up here, and it actually closed higher than this high. And then the next day, it gapped up a little more, so this is a gap. It gapped, it gapped up. When the open is higher than the close, something happened in aftermarket trading, after hours trading, which is from 4 p.m. until 8 p.m. the night before and 4 a.m. to 9:30 a.m. before the market opens at 9:30, trading occurs and it went up in that period of time and it maxed out right there. And that is on May 2nd. So the question says, which day had the highest price? And it was May 2nd. And which day had the lowest price? That was April 29th. And that's the answer to example 1. Okay, now the check your understanding says, between which 2 days did after hours trading appear to have the biggest impact on the difference between the closing price and the following day's open? So let me erase all of this. All right, I like how they're addressing the open and the close and the after hour trading. So if I look here, this closed at 8.21 and it opened around 8.22. So that was about 1 penny difference, no big deal. This here is 8.12 and then it opened up here at 8.22. So that's about 10 cents. Okay, and then this looks like it closed and opened right about the same. So I'll call that 0 change. And then right here is 8.46 and up here is 8.55. So that's about a 9 cent change. Okay, so the largest change in after hours trading occurred right here between the 29th and the 30th. Okay, so that's how you read open and close prices. Okay, now we're going to talk about volume. Volume is really important in trading, by the way. All right, so example 2, approximately how many shares of Gold Point Manufacturing Company were traded over the 5-day period? So we want to look at that volume chart that was below the candle chart for open and closing and highs and lows. This is the volume in millions, $1 million. Okay, so this on the 28th, let me see my pen wax. So I usually have to do this. Okay, there it is. On the 28th, this is the maximum of volume, and here's 150. 160, 170. I'd say that'd be about a 180 million shares. On the 29th, it's down here. And if this is 50, this might be approximately 70 million. Okay, and right here, let's just maybe call that 80 million. And then here, back down to about 70 million. And then here, I don't know, 85 million. I'm just approximating because this isn't very accurate. So if I take that 180 on Monday, 70 on Tuesday, 80 on Wednesday, 70 Thursday, 85 on Friday, 8 and 7, 15, 23, 38, 3, 4, looks like 485 million shares were traded over that week. Okay. And what does the book say? 490 million. So there you have it. It's an approximation. I'm off by 5 million, but when you're talking about almost a $500 million, 5 million isn't really a whole big difference. But that's how you read volume. Okay, so now let's see. Use the stock bar chart to write a brief financial story of the trading action that occurred on Gold Point Manufacturing Company on April 28th and April 29th. Begin your story with, on April 28th, 1 share of Gold Point Manufacturing Company opened at $8.15. During the day, continued, to be continued. Okay, so I brought in that graph. So April 28th to the 29th, we are talking about these first 2 days right here. All right. So we're going to start off by saying on April 28th, 1 share of Gold Point Manufacturing Company Corporation opened at $8.15. During the day, it saw a low of $8.10 and a high of $8.42, and it closed at $8.21. Make sense? Okay, so then after our trading gapped it up 1 or 2 cents, it opened at 8.22. It saw a low that day of 8.07 or 8, and it saw a high of 8.37 or 8.38, and it ended up closing below the open down at $8.12. Okay, so that's how you read that. That's what happened throughout the day. And let me recap with the actual words. So on April 28th, shares of Gold Point Manufacturing Company opened at 8.15 right here. During the day, the shares reached a high of approximately 8.42 and a low of 8.10 per share. They closed at approximately 8.21. On April 29th, it opened at approximately 8.23. During the day, the shares reached a high of 8.37 and it dropped to a low of 8.07 and it closed at approximately 8.12 per share on that day. So there it is. That's how you read a chart. Okay, example 3 says to use the information below to construct a one-day stock bar chart for Brown Armor Corporation. So they gave us an open, they gave us a close, they gave us a high, they gave us a low, and they gave us the volume. Okay, so what we're going to do, I'm just going to try to do this with technology. So you want a candle, okay, something like that. All right, so the low of the day is down here at 39.39. So if I draw a line just above that, and let's make it like blue or blue, whoops. So if I drew a line across like so, all right, so that's a penny below $40. So then if I label this $40, then this is 39, not 39, right? Just below it. The high was 40.65. So if I copy this line, all right, and bring it down to say, I don't know, here, like so. Let's see, 39.39 low, high 40.65, open, close 39.79. All right. Oh, low 39.39. Yeah. So not 39.99. I'm going to move this up a little bit and put 40 here. $40 right there. And even that's a little, it's tough to do this. That's why they have programs that do it automatically for you. So let me just label this up for starters. I'm going to put a 39.39 there. It closed at 39.79, which might have been here. So there's my little close line right there. Close line, haha, dry your clothes. And open line, 40.10, $40.10, but the high was 40.65. So I'm just going to put 40.65 right here. And 40.10 might be down here somewhere, and that's where the open was at 40.10. All right. So if I create some more of these lines, let's just put one smack dab in the middle and call that $40. Whoa, what happened to my 40? It exploded. Let me just rewrite it. So this is $40. 40.10 is just a little bit above. So let me move that up a little smidge, like right there. So this is 40.10. So maybe move that closer to here and call that 40.25. Okay, this is 40.10, this is 40. And if I go in quarters, then this would be 39. I need another line. So this would be like 39.75 right here. And then another one at 39.50. And you get the idea. So then 39.50 might be down here a little further. And that 39.39 might be down even lower than this, down here. Okay, this is 39.50. And all these lines should be equidistant. Okay, and so 39.50, 39.75, 40, 40.25. You get the idea. It's a little bit difficult to do here. There is a picture in the book, by the way, but I just wanted to show how they did this. And the close was 39.79. So now I can move this up to, say, here and get rid of this. I double wrote it. So the 39.39 is the minimum. Like so, 40.65 was the high, 40.10 was the open, and 39.39. I'm sorry, close 39.79 is a little bit more than 39.75, which is right here. Okay, so I think that looks about right like that. And then we want to do a volume chart down below. So the volume bar is going to be another box, and these could be filled in. I could shade these like so. Oops. Okay. And it was, I don't know, someday, I don't know, but what, they didn't say what date it was. A one-day stock bar for, all right, so the volume is 44,500,000. So if I draw a line and like so, let's make that a little thinner. Okay, so there's 0. And if I duplicate this and draw it, you can do this with a ruler, like so. And then I can duplicate 2 of them. And like exponential growth here, like so. Make sure they're all lined up. Get it? All right. Copy those, copy that. Make sure they're equally distanced apart. All right, so let's get, I didn't want to get rid of that one. Keep that one. Let's get rid of this one. Okay, so there's a bar chart, if you will, for volume. And let's do it in millions. And it's 44,500,000. So if this was 0, and we go by 10 millions, 10, 20, 30, 40, 50 million, then I want this at 44. So now I'm going to shrink it down. Oops, grabbed the wrong thing. Struggles are real sometimes. Okay, so I want this at 44, which would be approximately there. And I'm trying to resize this so it looks like 44. And something like that. 10, 20, 30, 40, a little bit more than 40,000, less than 50. So there would be a volume chart, and let's move this to the front. Order, bring to front. So there it is. That's what it would look like. There's your volume bar, over 40 million shares, between 40 and 50. And that's about as accurate as we can get this way. Again, there are computer programs that do this automatically. That Tastyworks has a platform. I use Schwab's Street Smart Edge, it's called. So now suppose that trading was suspended for one entire day of a corporation. What might the stock bar chart look like? Well, suspended for a day. That does happen, by the way, if it's really volatile. The last time the stock market suspended trading was back in March or February of 2020. The stock market was just, it took a huge dump, and people were like getting out of all their stocks, selling like crazy. They were panicking. So they freeze the trading, they suspend the trading to try to prevent another Black Friday that occurred. Black Friday? Anyway, back in 1929, the stock market crashed. Okay, so when I said Black Friday, I was thinking of the shopping day, the day after Thanksgiving. It was Black Monday. It occurred on a Monday. The stock market crashed back in 1929. Okay, so anyway, they suspend trading for one entire day for a corporation. What might the stock bar chart look like if they suspended trading? Let's take a look. Okay, so this is about what it would look like. So let's just say it happened the day after this close right here, and it was right there after hours trading, didn't make it move much, and it's right there. The candle or the chart would be just a line. The low equals the high equals the open equals the close. Everything's the same because it didn't trade. So the volume would be zero. And I don't care if you put millions, trillions, zillions, zero of anything is zero. So that is what a chart would look like if the stock did not trade for a day. Okay, this is a more common graph or chart. I use these candlestick charts. So this is a candlestick chart from September 7th to the 11th. All right, let me use blue. So it says number 4, example 4, explain the difference between the market action on September 8th, but I turn that blue, compared to September 9th. Okay, we're comparing these two candlesticks right here and right here. All right, let me explain the candlesticks to you first. If they're green, the body shows where it opened and closed. Okay, right here and here. If it's green, the open is lower, the close is higher. If it is red, the open is higher and the close is lower. Hopefully that makes sense to you. So if it opens at $39.27 and closes at $39.50, it went up, so it's green. This one, it opened here and it closed here, and this is the daily minimum, and this is the daily high, the high and the low. Let's call it low, not min. Okay, and that is a candlestick. Low of the day, high of the day. Open is down here at the bottom of the box and close is at the top of the box when it's green. Open is at the top of the box when it's red and close is at the bottom of the box when it's red. This is the daily low and this is the daily high. Okay, so let me erase all that mess. And now let's compare the 8th and the 9th. So in looking at this, I would say, all right, on the 8th, it opened here and closed higher. It dropped way below where it opened, but recovered and then went up higher than where it closed. So it was fluctuating around quite a bit. Whenever you have long candle wicks, that means there was a lot of volatility, it's called, and a lot of fluctuation. On the 9th, it opened here, closed way lower. Well, the larger the body of the candle, the bigger the move. And the wicks really don't mean much if you're trading over a period of time. The wicks mean a lot if you're day trading. If you are a day trader and the stock opens here and you sit patiently and you watch that go down and you watch it go down and you say to yourself, if that gets to 38.75, I'm buying it. So it gets down to here and it gets lower, but then it starts to come back up and you buy it at 39.75 and it continues up, up, up and goes above the daily close and stops right here before it retraces back down to the close and you get out at 39.50. Well, you made 75 cents, even though the stock only traded from open to close. This is about 39.20, and this is 39.30 or 35, so 10-15 cents difference. But if you bought it down here and sold it way up here in the same day, it's a pretty good significant change. So that's how day traders do it. Okay, so hopefully I explained the difference between the action in September 8th and 9th. Okay, this opened lower than it closed, so it had a gain in the day. This one opened higher than it closed, it lost on the day. Okay, so now we'll check your understanding. It says interpret a green candlestick that is shown as only a rectangle with no lines at the top or bottom. So let me show you what that would look like. let me grab this and let me make the line color. Oh, how about no line color, or green, or the same color as the body? So if I drew that, there's a green candlestick, no wick, top or bottom. What does that mean? Okay, well, this right here is the high. This right here is the low, but it's also the open. And this is also the close. Okay, it opened, it went up all day, it closed at its maximum or its high. They call it the HOD, high of day. All right, and LOD, low of day. So it opened at the low, closed at the high. It never dropped after getting to a max, or it never went below the open. And that's what it means. Okay. Okay, example 5. What was the approximate difference between the highest price and the lowest price for the week shown in the candlestick chart for September 7th to the 11th? Okay, so the low is where the wick comes all the way down here. That's 37.75. Okay, so it hit its low on Friday the 11th, and it came up a smidge from that, but it closed out at 37.77, it looks like. Okay, but it did get as low as 37.75. Started the week opening here. So it opened Monday morning right there at 39.20, between 39.25, 39.30, 35, somewhere around there. It got all the way up to here. High of the day was 39.75. That's about 39.90, I would say, approximately. Okay, so here's the high and here's the low. So it said, what is the approximate difference? So you take 39.90, the high of the week, subtract 37.75, which looks like about the low of the week, and I would get $2.15 to the negative. Okay, so negative 215, this decreased $2.15. So now it says, check your understanding. The lengths of the candlesticks for September 8th and the 11th, let me erase this now. Okay, the length of the candlesticks for September 8th, that's this piece right here, but it's the wrong day. Let's try that again. The length of the candlesticks for September 8th, let me do it just this way. This body right here, 8th and the 11th. So we're focusing on these two right here. The lengths of the candlesticks for September 8th and 11th are approximately the same. What does this mean about the trading price on both of those days? Okay, so what they're talking about is they're taking this to the high and bringing it down to the, let me redraw that. Let me delete that. So what they're talking about is the whole candle. So from here to here and from here to here are approximately the same from the high to the low. Okay, what does it mean about the trading price on both of those days? Okay, well, the trading price fluctuated the same amount. The differences between each day's high price and low price were about equivalent. So high minus low were equal. If the candle's the same size. Okay, and that's what that means. All right, so that's the end of chapter 8.3, I believe this was. Yes, chapter 8.3. So hopefully you found this helpful, and thanks for watching. Have a great day and peace.